Welcome to vTalkInsight, Risk Sentiment Daily for January 13th, 2026. A powerful U.S. growth story is now colliding with an unprecedented political assault on the Federal Reserve and mounting geopolitical tension, forcing investors to reassess where they take risk and how they hedge it. Let's map out what is driving risk appetite across assets today. Risk sentiment today looks cautiously risk-on, but clearly more fragile than even a few sessions ago. Strong U.S. growth, resilient earnings expectations, and ongoing demand for cyclicals and small caps are keeping investors engaged in risk assets. At the same time, the backdrop has darkened, with aggressive legal actions against the Federal Reserve, populist policy proposals, and rising geopolitical stress in energy-producing regions, all lifting the perceived risk premium on U.S. assets. Cross-asset price action underlines this tension. The S&P 500 finished the latest session modestly higher, and headline volatility remains contained, suggesting the core equity narrative is still intact. Yet the dollar is trading weaker than modeled fair value. Long-end Treasury yields are pushing higher, and gold and silver are at or near record levels, all consistent with investors paying more for protection even as they stay invested. Compared with the unusually calm, low-volatility regime earlier in the month, the market now feels more two-way and policy-driven. The growth and earnings engine is still pulling risk assets forward, but it is now running alongside a visible buildup of political, legal, and geopolitical tail risks. How that balance evolves will hinge on whether today's policy shocks are contained or escalate into lasting damage to central bank credibility and global energy supply. A central bullish driver is robust U.S. growth and earnings momentum. Real activity is running well ahead of what most forecasters expected a year ago, with GDP tracking around 4 to 5%, powered by AI data center investment, a strong energy sector, and expansive fiscal policy. Nominal growth projections for next year have been marked up from roughly 3.5% to about 5.5%, implying an additional several $100 billion of economic output compared with prior expectations. Importantly, strong productivity gains are raising estimates of the economy's potential growth rate. That opens the door to above-trend real growth without immediately reigniting inflation, supporting a narrative of a disinflationary or low-inflation boom rather than an overheating cycle. Recent data, including the strongest monthly gain in core retail sales since mid-year, point to a consumer that is still spending despite dour sentiment surveys, reinforcing the idea that demand remains healthy. This macro backdrop feeds directly into earnings. U.S. equities are expected to deliver mid to high single-digit earnings growth this quarter, with upside coming from lower rates versus last year, a softer dollar, and still supportive energy prices. Banking sector fundamentals look particularly solid, with loan growth accelerating into the mid-single digits, investment banking fees running ahead of consensus, and broader earnings growth expected into 2026 as AI-driven efficiencies and capital markets activity build. Together, these trends give investors fundamental cover to stay allocated to risk, even as they worry about policy and geopolitical shocks. Another supportive force is broadening equity leadership and sector rotation. Market leadership is no longer confined to a narrow group of mega-cap technology names. Industrials and mid-cap stocks are increasingly in focus, helped by capital expenditure plans and trading at roughly a 30% valuation discount to large caps, while small-cap cyclicals have outperformed large caps for several sessions in a row. The banking sector illustrates this rotation. Despite headline volatility around proposed credit card rate caps, large-cap banks are benefiting from stronger loan growth, expectations of higher net interest income as the curve steepens, and better-than-expected investment banking revenues. In parallel, flows into mining and resource stocks are picking up as gold, silver, and copper prices rally, positioning basic resources as early leaders in some trading sessions and offering an alternative way to gain cyclical and inflation-linked exposure. These shifts mean index-level moves tell only part of the story. Active management and stock selection are regaining importance, with investors rewarding companies showing productivity gains, margin discipline, and clear earnings visibility. The takeaway is that Beneath the noise of political headlines, there is still a constructive rotation toward a broader set of risk assets, even if some areas like banks and small caps remain sensitive to policy surprises. A third bullish driver comes from targeted policy support and liquidity measures, especially in housing and credit. A notable example is the roughly $200 billion purchase of mortgage securities by U.S. housing agencies, which has already delivered around a 0.25 percentage point drop in mortgage rates. This kind of quasi-quantitative easing in mortgages is aimed squarely at improving housing affordability and easing financial conditions for households, even as the Federal Reserve keeps its policy rate on hold. Policy direction also matters on the regulatory side. Despite populist proposals to cap credit card interest rates, key Treasury officials are not backing such measures, and the broader trend remains one of incremental deregulation for large banks and capital markets. In digital assets, bipartisan work on a crypto market structure bill signals progress toward clearer rules, which could, over time, support greater institutional participation and liquidity in that ecosystem. These interventions and regulatory shifts together reinforce a sense that policymakers are willing to lean against pockets of stress, particularly in housing and credit, that can cushion downside risks and sustain risk-taking. The risk, of course, is that aggressive support contributes to asset froth in areas like housing or precious metals, or blurs the line between monetary and fiscal policy, which in turn feeds some of the very concerns about central bank independence that are unsettling investors on the bearish side. On the risk side, threats to Federal Reserve independence have become the dominant concern. The Justice Department's grand jury subpoenas and a criminal investigation involving the Fed chair are viewed in markets as highly political, raising questions about the central bank's ability to set policy free from short-term political influence. Escalating tensions between the White House and the Fed, including public accusations and legal maneuvers, create a perception that the institution itself is under attack rather than simply its policy choices. Former Fed chairs, Treasury secretaries, and other senior financial figures have issued coordinated statements warning that these moves pose a foundational risk to central bank independence and could push the U.S. toward emerging market-style policy instability and inflation. Markets are reacting. U.S. assets are trading with a rising risk premium, the dollar is weaker than model-based estimates, and investors increasingly frame political interference with the Fed as a structural, not just tactical, risk factor. At the same time, some indicators such as long-term inflation expectations and inflation swaps remain relatively well anchored, suggesting investors still assume that institutional checks will ultimately hold. The real risk is that any further escalation, such as attempts to remove Fed leadership or legal rulings that weaken governance protections, could rapidly undermine confidence in treasuries and the dollar, forcing a more abrupt repricing across rates, equities, and credit than we have seen so far. Closely linked is the bearish driver of rising long-end yields and term premium. The U.S. yield curve is steepening as 30-year yields move sharply higher, with some investors now bracing for the long bond to test or exceed the 5% area. This move reflects several forces at once: political uncertainty, concerns about future inflation, and recognition that larger deficits and heavy issuance may require investors to demand more compensation to hold long-duration treasuries. Rate expectations are also shifting. Some major houses now see no Fed rate cuts at all in the coming year, and the market narrative has evolved from how many cuts toward the possibility that policy could even tighten again if growth remains strong and fiscal stimulus persists. Commentary highlights that long-end rates and credit spreads could continue to rise even if the Fed eventually cuts, because term premium and political risk are doing more of the work in pricing rather than just the expected policy path. For portfolios, higher long-end yields have two important implications. First, they challenge the traditional role of long-duration government bonds as reliable hedges, especially if equities and bonds sell off together on policy or inflation scares. Second, they raise discount rates for long-duration cash flows, which can cap valuation multiples for growth assets even when earnings are solid, helping to explain the renewed interest in shorter-duration equities, financials, commodities, and alternative diversifiers such as gold and multi-strategy vehicles. The third major bearish driver is escalating geopolitical and energy market risk, with Iran squarely at the center. Iran is facing severe economic distress, including extremely high inflation, currency collapse, and widespread social unrest that many observers see as the most serious challenge to the regime since 1979. There is a high perceived likelihood of U.S. military action or additional sanctions, and any miscalculation could draw in regional actors and significantly raise the geopolitical risk premium across Middle Eastern assets. Energy markets are particularly exposed. Disruption at the Strait of Hormuz would deliver a severe shock to global oil flows, especially given current positioning and limited preparedness, with insurance costs likely to spike and shipping routes rerouted. At the same time, Venezuelan production has fallen sharply from prior levels, and major oil companies see both Iran and Venezuela as largely uninvestable under current security and legal conditions, limiting the capacity to offset any new supply shock quickly. Interestingly, spot moves in oil and core bond markets have so far been relatively contained, with only modest equity declines in response to recent Iran headlines. However, safe haven behavior is unmistakable. Gold has reached record highs, silver is posting consecutive double-digit monthly gains, and mining equities are leading in some sessions, while the dollar softens and volatility edges higher. The risk is that a sudden escalation transforms today's slow build in risk premium into a sharp repricing across energy, currencies, and broader risk assets. To sum up, markets are still leaning cautiously risk-on, anchored by strong U.S. growth, broadening equity leadership, and targeted policy support, but that optimism is being tested by rising threats to Federal Reserve independence, higher long-end yields, and mounting geopolitical and energy risks. Key variables to watch now are the trajectory of U.S. political interference with the Fed, the behavior of the 30-year Treasury yield and term premium, and any sudden shift in the Iran and broader Middle East situation, all of which could quickly change the balance between risk-taking and protection. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.